Coincidentally, COVID hit and gave central banks and governments unprecedented excuses to create more debt and print more money, and that reinflated the system.
Trump's new policies could potentially stave that off, or does that only exaggerate things?
His plan is this, right? He wants to deregulate, reinstitute the tax cuts. He wants to bring investment to the U.S. Just the second derivative change on that is going to create a dip. The real economy, the middle class economy, you could argue, was in a recession in 23 and 24. So if you have a global debt problem, there's two ways to handle it. Your way out of it, or you...
Ed, you said that you've been saying that there's a clock that started on a global debt crisis. Like, what are you looking at that broke? And why should anyone listening right now be preparing for that?
Well, look, the global debt crisis kind of manifested itself in 2019. There was a lot of synchronized global growth slowing, and the repo market started blowing up in September of 2019. The plumbing was becoming unwound. Coincidentally, COVID hit and gave central banks and governments unprecedented excuses to create more debt and print more money, and that reinflated the system. So if you have a global debt problem, there's two ways to handle it. You inflate your way out of it, or you default. And COVID, again, I wasn't in the room. We can debate whether it was a plan or an accident. Who cares? It saved the system temporarily, kicked the can down the road. And the Fed printed and the U.S. government spent. Printing without spending doesn't mean anything. So we saw unprecedented growth in the money supply. And my partner, Carlos Alegria, in his book that he had a revised edition in 2021, predicted that massive inflation was coming, and it came. And, there's a little bit of a debate as to who caused the inflation. I would say what they did under the Trump administration with the COVID spending and the printing didn't really have an impact until, 12 to 18 months later. And that was in the Biden administration. So, inflation, which quote unquote was transitory, that's what we were hearing from, Yellen and Powell, was nonsense, because monetary, when you increase the money supply without commensurate like growth, it's just going to inflate prices, and it did. And so the Fed then responded by going on an unprecedented rapid interest rate increase from basically 0 to 5.5%. And M2 year-over-year growth plunged in the aftermath, and we saw for the first time since the 30s, M2 year-over-year growth went negative in November 2022. And then, unsurprisingly, we had a bunch of bank failures in the spring of 2023. People forget that. And the Fed plugged the hole. They gave a bank term funding program. They lent monies to banks that were underwater to prevent a deposit run. And that worked, because most of the credit that was underwater were, risk-free assets like treasuries, because of, the duration risks that happen when they raise interest rates. So what the Fed's not going to do, and they've already ended the bank term funding program, what the Fed's not going to do is lend money to bad credit. And we're getting into the credit cycle of this. Commercial real estate, as we know, is already a problem. That's about 3 to 5 trillion on banks' balance sheets in the U.S. The bigger problem we see is the economy having been floated in 23 and 24 by illegal immigration. A large part of our growth came from that whole movement into basically an organized illegal operation that, we think a large majority of the deficit spending we saw funded that through NGOs and other agencies. And then direct payments to illegals. So that really floated the economy, and that's all coming away. So we see a housing crisis coming next. And when we say crisis, I don't want people to freak out. I mean, it's needed. I mean, home prices need to come down. People can't afford homes. And new home supplies, at all-time record or near all-time record levels. There's no transaction activity, and the housing market was really buoyed by the marginal renter, which was the illegal alien. That momentum's all going the wrong way, and PMI, has been a problem for 2 years. It's been showing recessionary signals globally, and the only economy that was really outstanding was the U.S. economy, and that's all. That's all going the wrong way. The second derivative, government spending, even though the Trump administration is really not cutting spending, the second derivative is changing. The growth is flattening, and that's all you need to cause a softening in the economy. And that's what we put out a report that we're selling on January 9th, detailing what we were seeing. And you can buy it if you want at our website, financetechnologies.com with a PH. So that's kind of the broad swath. We're already starting to see indications that the economy is slowly starting to roll over, and we'll see if our call's right. We think we're going to be right in a very big way.
Well, thanks for setting that stage on that. Let's dig into a couple things on that. You said, I think what you said is after you talked about the Fed bailing out the banks in 2023 through the BTFP, that the Fed is not going to give money to bad businesses or bad investments anymore. I think that's what you said.
They're not going to loan money to. It was easy to provide liquidity versus treasury assets that were underwater. They're not going to provide liquidity to bad loan decisions, bad credit decisions. And what's going on with the commercial real estate problem? And by the way, this all eventually affects lending. A bank's main function is to juice the economy by lending. When you start to accumulate bad debts on your books, you stop lending as much. And what's going on with the commercial real estate is they've been extending and pretending. And the Fed put out a report in November of 2024 detailing that. And I think they're going to start cracking down on banks. Coincidentally, during the Trump administration, that may be a political move, who knows? But I mean, this has been a problem for well over a year and a half. There's also starting to be indications of problems in auto loans, and there's delinquencies in homes are rising. So we have a classic credit cycle coming, and it's just inevitable, and it'll cause the word deflation to be mentioned temporarily, because we know that deflation is not allowed under the rules of the bankers. So we're predicting inflation CPI headline to sometime in the next 6 to 12 months print a sub 2% number. The biggest component of inflation is shelter. It's about 45% of the CPI number. That's sticky. It takes time to adjust. And so we're expecting a recession. We're expecting the Fed to do what it does, lower interest rates, and then maybe if the crisis is, if it looks like it's going to go systemic, they're going to print a ton of money, and the government will have to do deficit spending, and then we're back in the reinflation of the bubble if they can do it again.
So you said deflation is not allowed in bankers' terms. It's really not allowed in a debt-based monetary system, just overall.
Correct. It's
right?
not. If allowed to go unchecked, the daisy chain effects or collapse.
Would you say, you mentioned, how this actually started in 2019 and then the COVID sort of excuse came along. Would you say that it actually started back in 2008 when we really sort of had the first QE? Maybe the Fed tried to allow the bubble to deflate like they had done in previous cycles, 2000, et cetera. But then it became too systemic, right? They had to bail out the banks. They had to do the quantitative easing. It levered up the system to a point now, and 2019, 2020 showed that and even 2023 showed there's zero appetite to allow it to sort of deflate on its own, and they have to keep reinflating.
Yeah, it's interesting you talked about the great financial crisis. That's when a lot of things changed. That's when we saw unprecedented monetary policy, which now everybody expects, and it's not as unprecedented. It's a tool in the toolbox. And what that did is the real economy, if you go back, really kind of died globally. And what floated the economy for the next 14 years was unprecedented monetary policy coupled with government spending. And the government, as a percent of GDP, not only in the U.S., but in Europe, China, you name it, grew its share of the pie in GDP. And that's changed a lot of, what's been going on economically. So the closer you are to government and government favors and the printing press, the better off you've done. So the economy showed growth, but the problem was over time, there was a wealth disparity effect. And that's why, if you want to ask yourself why populism is on the rise, it's basically because the rich got richer and everybody else got poorer. And it's been an economy of the rich, not of the middle class. And Trump was elected primarily because there was minus 2% real wage growth going into the election. The last time that happened in 1980, Ronald Reagan swept in, and it's Bill Clinton in 92. So, Trump was going to win no matter what because of the economy. It didn't matter.
Got it. So if the system structurally, fundamentally changed in 2008, got so levered up, you could see 2019, 2020, the response was way faster, right? 2008, they allowed Bear Stearns to go down. It took 7 months to get a bailout. In 2023, it took 6 days to bail out the banks. But you think that now maybe the Fed would sort of change their tune and say, well, let's just let these bad loans go bad and let's see what happens with the deflation?
Well, it depends. They can't be seen as bailing out. Politically, it's going to be a lot harder to try to bail out the banks. And during 2020,
sort of like take the loans on their books like they did with the MBS in 2008. Like, you don't think that's politically sustainable?
Well, they could do it, but they will only do it if there's enough pain. So that's why they'll do it, but they'll do it after a big correction and people are freaking out and beg them to do it. They don't want to do it ahead of time. 2020 gave them great cover. I mean, they bailed out Citadel Capital. They gave them emergency repos during 2020, and there was also, and they also basically privatized the corporate credit market. They started buying. I don't know if people remember this, but they started buying onto their balance sheet Apple bonds. So they basically privatized the corporate credit market. The problem with that is it's kept corporate credit spreads tight. And that's driven a massive amount of misallocation of capital, as you would imagine. So, right. And the other problem is this. In the dot-com boom, we had a corporate fraud cycle, and then, we had the Fed do their easy money after that bust. That led to a banking fraud cycle, and now we have 14 years later I would say a central bank government fraud cycle. And we're discovering all sorts of fraud, through what Doge is exposed and whatnot. And it's not so much that the Fed will become trapped when another central bank has a problem. And the Bank of Japan is kind of in a problem right now. They can either, continue to print money to float the yen carry trade, or their people will continue to get poor and there's a currency crisis. So the release valve on the sovereign debt crisis was always going to be the currency markets, because eventually the currency markets will revolt if one country, if the markets determine no mas, then it's over. And then the whole thing has a problem. So the Fed, is the Fed going to bail out Japan? I mean, right? So this is where we are. It's very precarious. We don't have a crystal ball, but what we do know is there's an economic slowdown coming. There's going to be, a problem in the stock markets, and we're expecting yields to go much lower. And obviously, if you believe our call, you want to be up to your eyeballs in risk-free assets like the U.S. T-bills, notes, and bonds. And not have anything with any risk assets.
I want to take a break real quick and just say that there's only so much you can learn through videos. Yeah, build your knowledge, build your skills, but you need to build your relationships. Relationships plus skills equals money. So Come build your relationships and your knowledge at the Bitcoin Conference, May 27th through 29th in Las Vegas. I'm going to be there speaking for the 4th year in a row, and lots of other people way bigger than me. Entertainment, politics, media, finance, you name it, they'll be there. So come check it out. Save some money with my code Mark Moss, or I'll put a link down below. If you use my code to save some money, I'm going to do a private meetup just for you and some of my friends. So let me know. Use that code, save some money, send me a message, and we'll get you in the private meetup, and I hope to see you in Las Vegas.
Let's come back to that, how you see this playing out, and I know we'll talk about the report that you said you have and how people can get a hold of that. Would you say that Trump's new policies, potentially this Mar-a-Lago Accord, restructuring the global monetary system, making America investable again, could potentially stave that off, or does that only exaggerate things?
No, look, his plan is this, right? He wants to deregulate, reinstitute the tax cuts. He wants to bring investment to the U.S. The bringing investments to the U.S. is going to take time. You know as well as I do, breaking ground, getting things going doesn't happen overnight. So that is out in the future. It's much like what happened to Ronald Reagan. Ronald Reagan had a recession in 80 and 81. He had a double dip recession. Trump is facing the same problem. His policies are going to take time to enact. The Fed is too tight at the moment, and his policies are actually reversing out the juice to the economy the last 2 years, which was unprecedented deficit spending, illegal immigration, and government job hiring. So just the second derivative change on that is going to create a dip, because the real economy, the middle class economy, you could argue, was in a recession in 23 and 24.
So we have $8 trillion of commitments to be invested in the United States, but to your point, that's going to take a while to see that come to fruition.
Yeah, commitments don't translate into money changing hands yet.
It does, yeah. Now, he has done quite a few executive orders laying the groundwork for like fast tracking these two things, coordinating through all the states to get these things through. I think it was any investments over $1 billion get sort of rubber stamped through. But even then, you're still talking years probably before that stuff happens.
At least 12 to 24 months, and so that's why we wrote the report. His reversal of his policies actually will cause a temporary recession, and then his other policies will bring us out of it. But again, there's a timing issue. So there's a valley before the glory, right? Now, right. It all depends on the execution, the timing. If the economy isn't turning around by 2026 midterms, we got a problem. So the idea here is you have a recession that we think manifests itself pretty soon, and the stock market's bottom sometime in the first quarter of 2026, and then you have a recovery. That's the ideal situation, and that's why in our report we're not in our report we're not claiming anything. It's going to go systemic. We're not doom and gloom. It's just we think it's an old-fashioned deep recession, and hopefully it's quick. And typically speaking, in recessions, like in the dot-com recession and the great financial crisis, stocks went down 50% before they recovered. So we're nowhere near down 50% yet, and we think that's coming. And look, it's not the end of the world, right? I mean, home prices going down are, while not good for over-levered rich people that are over their skis, it's great for like someone who had a first-time home buyer. So, it's just not. People just don't like recessions, and they think it's the end of the world. But it's healthy, and it resets things. The problem is, the bankers don't like it, and they keep reinflating and creating malinvestments. So we're going to see what happens in the teeth of this one. The Fed is behind the 8 ball. They didn't lower I predicted they weren't going to lower this Wednesday. They didn't, and we might even get some headline inflation reports that look like inflation's accelerating. But you got to remember, in the great financial crisis, inflation was accelerating June, July, and August before everything imploded.
It seems like when you have basically a heads or tails sort of thing where we either continue to inflate this bubble and have more inflation, or we let it deflate. And to your point, maybe that's a good thing to let asset prices, house prices come back down, sort of give that next generation a chance. It just seems like if people were given a choice, like which one's more bearable, most people would probably rather see their retirement accounts and their house, et cetera, go up in value, even if the price of gas and food went up a little bit, versus all their prices come crashing down, their stock, retirement accounts, house accounts all come crashing down, their businesses suffer. So it seems like maybe if people had to choose, and the government having to deal with sort of the public's view on this, seems like they'd probably choose inflation. But
I think it's a generational issue, right? So we have the baby boomer generation that has a lot of the wealth in the country, who wants to see policies that protect themselves. And then this is classic generational warfare. My partner, Carlos Alegria, writes about it in his book, Economic Cycles, Debt and Demographics. This has gone on, many times before in history. So we have what many would call a fourth turning. I mean, this is a generational war. You have the young people who are locked out of a lifestyle that their parents and grandparents experienced and are still holding on to, and that's why populism is rising at the moment. And you can see, I'm sure you're online a lot. I'm not a boomer, I'm a Gen Xer, but I get called a boomer. Okay, boomer.
Yeah. How much of that would you say is attributed more to where we're at in technology? So, for example, right, like the baby boomers had a massive middle class because we had the industrial age and we had assembly lines. And so smart people and dumb people were marginalized, and they all did just put their piece on the widget as it went down the assembly line. So we got this massive middle class. But as we moved to the information age, especially, and as we've accelerated into that now with AI, it's almost more of a meritocracy where if I'm smarter, I can just use my laptop, I can just get ahead, and that middle class sort of goes away, and maybe there's no returning to that.
That's what Trump is trying to address by bringing manufacturing jobs back. It's a bold move. We'll see if it works. The other thing to remember, though, is when you have, let's say you bring a manufacturing plant to a town, I'm talking microeconomics, and you hire that, like, just say 1,000 people. That creates jobs for those people. Those people then spend on ancillary services like housing, restaurants, services. So there's other jobs that are created by that steady base of manufacturing. And, that's what we saw happen to a lot of Midwest towns during the outsourcing of manufacturing in the U.S. in the 90s and 2000s. Under Clinton, Bush, Obama, and what have you, we saw towns. I mean, I drove across the country, Midwest towns, just like the plant left, and they're just shadows of their former selves. So Trump, I think, idealistically wants to bring back that kind. Whether it works or not, we'll see. And you're right. There's been a change in the nature of the workforce, and unfortunately, IQ has a lot to do with it.
And our education system isn't helping at all.
Our education system is a disaster. Look, I went to public school and I learned a lot. It was great. And I think that's been a lot of people's experience that are my age. I hear what's going on in the public school system now, and it's a disaster.
My daughter is a sophomore in high school, and she's homeschooling. And she just wants to just take her test and get out. And I'm like, just drop out. Like, I don't care. There's nothing that they're going to teach you at this point that you need to know. Like, you're already working for me. You're already learning more cutting edge marketing stuff than they'll ever teach you in that industrial era school. So it's almost like people are being still trained in an industrial era school system with industrial age tools, and they're being left behind because that world no longer exists for them. And unless we change that, we're still going to have this populist uprising, which is going to continue to push things. And if inflation continues to rage on, they continue to fall further and further behind. So, yeah, it's not a good fix. I want to ask you, when we talk about these debt crises, I don't believe that we'll pay the debt down. I mean, it's more about management. It's almost like medical systems today, right? Let's manage the symptoms. Let's not try to cure it. And so we have this debt bubble. It's a problem. Debt to GDP levels are extremely high. Obviously, the interest on the debt is has become a big problem, which is why rates need to come down. Would you also believe that, one, it can't ever be really repaid, so that's not really the goal that we're aiming for, but it's more about like a management of it, and like as we've seen other nations just like sort of muddle along with it for long periods of time? And does that mean it's not as acute as many people think it is? It's something that maybe just continues to sort of drag the economy down over a long period of time?
Yeah, so there's two choices, as I said: inflate it away or default. Default is probably not an option. So they will inflate, and this is we'll be in we're predicting stagflation. So bouts of inflation with deflation, net result stagflation. Kind of this, this kind of like roller coaster ride as the monetary policy has less and less impact. And so the goal, I think, is to try to muddle along. The problem, of course, is societally what happens to the populations of the globe. And one result is populism. If you're in China, China is a communist country that rules from the top down. They fear their people the most. When I was at BlackRock in 2003, our energy guys came back from China, and everything they said was all the high officials there want to keep max employment so the people have food in their belly because they fear their people the most. China has a demographic problem. So China's solution to this will be a distraction, likely, warmongering. And that's why, geopolitically, these debt problems engender wars. It's kind of classic, right? The leadership of a country isn't going to take responsibility, so they'll blame someone else. So we think China's at risk of going kinetic sometime in the next, 5 to 10 years. Europe has a demographic problem, and we have as bad as our demographics, we're like the best, the cleanest shirt in a dirty laundry. And the illegal immigration did help the economy short term. The problem is societally, it wrecks the social fabric. So there's a trade-off. And it's going to be very interesting to see what happens over the next 5 years. I don't have a crystal ball, but what I can say is volatility and risk are going to continue to be unprecedented. And I think the 14 years of low volatility are over.
I would agree. I saw this quote, Warren Buffett just decided to step down after legendary status over at his company, Berkshire Hathaway. But I saw this chart. Over the past 45 years, Berkshire has returned 331,000% compared to the S&P 500's 14,000%. However, during the same time frame, gold basically kept even with Berkshire. He didn't really beat that. And it really kind of goes into this monetary debasement. And he said, the tendency of government to want to debase its currency over time, there's no system that beats that. You can pick dictators, you can pick representatives, you can do anything, but there will always be a push towards weaker currencies. The natural course of government is to make the currency worth less over time. He seemed to sort of make the case for Bitcoin, even though he hates Bitcoin and he hates gold. I'm curious your take, as you said, sort of this volatile nature that we're going into, markets potentially looking very risky, risk assets, you called that. As this world sort of goes through this sort of breakup, if you will, do you see like a rush to gold and Bitcoin assets really kind of taking over?
Well, let's talk about gold first. What's interesting about gold is they're making it money again. If you've been following Basel III, and July 1st of this year, it's going to be instituted in the US. Gold will be considered tier 1 capital and not paper gold. So not the ETF, GLD or futures, physical gold. And so banks are going to start and already have been acquiring gold because you can lend against it. You can create money from it. In 71, when we delinked from the gold, they turned it into a commodity. They're making it money again. And so gold, interestingly enough, is being re-liquefied as money. And I think that's why gold is doing what it's doing slowly. I think physical gold. I don't want to encourage people to buy paper gold, physical gold. Right. Bitcoin is a legitimate asset. And I missed it, so I'll just say that I did not get involved. Bitcoin at the moment is very volatile, and if you're looking at it as a hedge against a coming recession, just be careful, because I'm a math guy and it's very highly correlated to the NASDAQ, and the NASDAQ is a risk asset. So, think of it as a part of your portfolio, and you never should have all your eggs in one basket. You shouldn't be 100% gold, 100% Bitcoin. And cash is also an asset temporarily, because if things are going to deflate, even though cash traditionally held over long periods of time, it's not a good idea. Look at what Warren Buffett's doing right now. He owns 4.6% of the T-bill market. That's cash effectively. He's earning 4% on it, 4.3%. And he's making the bet that cash is a good trade at the moment because he's going to pick up bargains in a dislocation. So cash is also an asset. But if someone had to put a gun to my head, I've been telling people, look, just have some dry powder to take advantage of the volatility that's coming. Don't be over levered, and don't be 100% any risk asset.
Yeah, I was just thinking, again, sort of looking at Buffett's record, and again, gold sort of keeping up with what Berkshire did, and to the point that you're making, maybe with a recession in front of us, but then probably a big stimulus print on the back end, and not just the U.S., China, et cetera. And then you think about, as the world continues to break apart, and do they want to trust U.S. Treasuries? And so then maybe those are the tailwind sort of catalysts for Bitcoin and gold. But that's more longer term. You guys are focused a little bit more shorter term.
Yeah. Look, if Bitcoin could prove to me mathematically it was delinking from risk assets, that would be interesting. But we need time to see that. Right now, it's not. Historically, it acts like a risk asset, and that's fine. It keeps printing new highs over time. But if you think a recession's coming, and you put all your money in Bitcoin, hoping to avoid preserving your capital, I'd be leery of that. That's all I'm saying. And maybe Bitcoin decouples during this recession and holds its value. That that could prove me wrong, but historically the correlation is it's a risk asset. So until that changes, it is what it is.
Yeah. Well, what about, it seems like in times of high inflation, those assets tend to get correlated, which is why like the 60-40 bond, stock portfolio is dead. They're sort of moving in unison right now. And, in 2008 and 2020, when the markets plunged, gold also crashed along with those. So is everything somewhat kind of correlated and tied together at this point?
Well, no, gold also, let's not forget, during the Great Financial Crisis, gold went down 50%. Right. When Lehman crisis hit, primarily because in a margin call that's global, you sell what you can, not what you want to. So everything gets hit, especially if it's on leverage. So, but interestingly enough, gold recovered quite quickly and went to a new high. The U.S. stock markets took longer to do that. So that's why Warren Buffett is probably in T-bills, because in a dislocation like that where everything goes down, T-bills don't go down, and then you have dry powder, and then you start scooping up everything.
Yeah. I think I saw, you probably know better, I think it was just off of the Treasury allocation, he's making 12 or 14 billion a year. I think some crazy number like that.
Yeah, no, basically he's getting paid to wait. What he's determined that risk assets are too expensive. He's not trying to time the market, but he's decided he'll wait for a correction and then he'll go back in. That's basically what he's telling you.
All right. So in your report, you're projecting, and we'll link to that down below if people want to check that out. But you're projecting that there's some big recession coming up, this year, probably in 2025. Sort of lay that out, what people should be watching, paying attention to, and sort of what you think from a big picture their sort of life raft is through that moment.
Well, again, it's structural. It's endogenous to the U.S. economy, meaning it's a cycle. It's going to happen. And housing is going to be the one that leads it. Interestingly enough, housing has 18-year cycles. The last one was 2007. Carlos, in his book in 2021, wrote about a housing crisis appearing sometime in 25, 26. And as we wrote the report, we're seeing it in real time. It's early indicators that lead. New permits started collapsing in 22. That's a leading indicator. So what we're seeing are completions. Once the completions dry up, that's an indication there's no demand, and we're starting to see that. New tenant rents have been coming down. That's probably due to the illegals either self-deporting or the stop of the flow. And new tenant rents lead all tenant rents, which lead home prices. And so it's just a cycle. Government spending is on the margin being cut, and that's going to affect the economy and consumption. And we're expecting this to become apparent sometime in the fall. The stock market, unfortunately, we have a housing problem and a AI bubble. So we're going to have a deflation of both. We think the AI bubble has already popped and is in process of popping. We think we saw peak spend in Q1, and it's downhill from there. And it's just classic second derivative stuff. And there'll be credit contraction. The money supply will come down, velocity of money will come down, and it'll cause a deflationary scare. And the Fed will come in and do what it does, and stock prices will revolt. And people will blame Trump, people will blame tariffs, but it's just a classic cycle. And we go into our report's 85 pages. We have also a video of us going over an executive presentation, which we also provide. So it comes with 3 components: report, executive presentation, and an hour-long video of Carlos and I going over it. And it's on our website at financetechnologies.com, and it's spelled with a PH. And if you buy the report, you'll get free updates as we track this. And when we think the bottom's in, if you buy this report, you'll get that report for free.
All right. Well, that's a compelling case. Appreciate you sharing that with us. We'll wait and see. I'm hopeful, but we'll wait and see how this all plays out.
Thanks a lot, Mark.